This week looked calm on the surface. A small rate cut, a quiet decision in Europe, and a tech investment most people ignored. But underneath, all three tell the same story. Power is shifting financially, politically, and technologically. Let's break down what actually happened and why it matters. On December 10th, the US Federal Reserve cut interest rates by 25 basis points, bringing the policy rate down to 3.75%. At first glance, that sounds bullish. Lower rates usually mean cheaper money, stronger markets, happier investors. But here's the catch. The decision was not unanimous. 3 Fed officials voted against it. Some wanted no cut at all. One wanted an even bigger cut. That tells us something important. The Fed is not aligned on what comes next, and the Fed made that very clear in its language. Instead of signaling more cuts, it basically said, "We've done enough. Now we wait." Chair Jerome Powell confirmed this, saying rates are now close to neutral, meaning the Fed no longer feels pressure to stimulate the economy aggressively. Or in plain English, the easy part is over. Markets initially reacted positively. Stocks went up, the dollar weakened, treasury yields fell. The S&P 500 closed higher. The 10-year yield dropped to around 4.15%. But this reaction focused on the headline, not the details. When investors looked closer at the Fed's projections, the mood changed. The Fed still expects only one more rate cut in 2026. That's much less than markets were hoping for. The infamous dot plot showed serious resistance inside the Fed. Several officials didn't even support this cut. So while markets celebrated short-term liquidity, the message underneath was hawkish. This is the Fed saying, don't assume a smooth path down. For investors, this changes the game. If rates stay higher for longer, bonds need stronger proof that inflation is falling, stocks can't rely on easy money, valuations matter again. This environment rewards cash flow, balance sheets, and real earnings, not hype. For businesses, the cut offers modest relief, but no miracle. Companies that expected refinancing to get cheap quickly may be disappointed. Investment decisions stay cautious, especially for highly leveraged firms. For consumers, borrowing costs may fall slowly. Mortgage and loan rates depend more on long-term yields than Fed policy alone, and inflation is still sticky. Even with lower rates, purchasing power isn't improving much yet, and uncertainty doesn't help. Data gaps from the government shutdown, political pressure on the Fed, conflicting signals from policymakers. Confidence matters, and right now confidence is fragile. Now let's go to Europe, where something much bigger happened. The EU agreed to indefinitely freeze 210 billion euros in Russian central bank assets. Before this, the freeze had to be renewed every 6 months. Now, it's open-ended. Now, why does it matter? Because those assets are being used as collateral for up to 165 billion euros in loans to Ukraine. Ukraine only repays if Russia pays war damages. Economically, that's almost a grant. This is no longer temporary sanctions. It's a long-term financial weapon. Russia responded immediately, calling it illegal and suing Euroclear, the institution holding most of the assets. This turns sanctions into a legal and geopolitical battleground. For markets, this raises uncomfortable questions. Central bank reserves were once considered untouchable. Now they're being immobilized and used. That sets a precedent. Over time, countries may rethink where they hold reserves, which currencies they trust, which financial systems feel safe. This could affect capital flows, reserve currency dominance, Europe's role in global finance. For the EU, it solves a problem, supporting Ukraine without adding debt. But the legal risks remain real, especially for Belgium, where most assets are held. This is finance merging with geopolitics permanently. And finally, let's switch over to tech. Meta confirmed it holds at least 3% stake in Essilor-Luxottica, the company behind Ray-Ban. This matters more than it sounds. Meta's AI-powered Ray-Ban glasses, they already exist. Photos, streaming, AI interaction. This is Meta's most concrete move beyond social media into hardware plus AI. By taking a minority stake, Meta deepens the partnership, avoids regulatory scrutiny, keeps flexibility. EssilorLuxottica benefits too: fashion credibility, manufacturing scale, global distribution. And competition is coming fast. Google, Apple, other tech giants. The real question isn't profits today, it's whether smart glasses become the next computing platform. Meta clearly thinks they will. These three stories are connected. The Fed is stepping back, Europe is stepping forward, tech is embedding itself deeper into daily life. This is a market environment with less certainty, more political risk, slower selective growth. And that favors fundamentals over narrative. No smooth rate cuts, no easy money, no simple stories. Just power, capital, and long-term positioning. If you have more breakdowns like this, please do subscribe and like this video, and let's build the bridges and not burn them. Thank you, and goodbye.